Hey, Renter Retires. Thank you so much for joining us on this episode of the podcast. I am joined today once again by the man, Zach Lemaster, here with me. And our third person with us today is Bill Brewer. He's an insurance specialist with Shelter Insurance. So, gentlemen, welcome to the show.
Thanks, Bill, for joining, and Adam putting this together to have I think, a very valid discussion. A lot of people are interested to learn about is property insurance. This is a necessity. We know that we all want to insure our investments. Also, a requirement by the lenders, but nonetheless, we want to make sure we have adequate insurance. But really, the big question we get all the time is what is an appropriate insurance policy for a rental property? What are certain things we need to be looking out for to ensure we have adequate coverage, but not overdoing it, because there's a lot of insurance policies that we see where quotes are just astronomically high and probably overdoing it from a rental property perspective. There's always that balancing act of finding the right insurance policy appropriate for a rental property, but making sure you're still covering all of your bases. So that's what we're really going to dive in today. We have Bill Brewer, who is an insurance specialist and agent here with Shelter Insurance. He's one of our go-to agents to provide insurance policies in many of the states that we operate in. Bill's an investor himself, and he's offered adequate insurance policies to many of our clients that we think is right in line with what you should have for a typical rental property. So, Bill, do you mind just starting off, giving us just a quick run through or brief history about yourself, how you got into insurance in general, and specifically, you're kind of the specialist tailored in the rental property space, and that's why we connected with you. But, if you don't mind, give us just a quick run through about your background.
Yeah. So I, excuse me, I'm battling the cold here, but trying to get over that. So I ended up going into the service in the Army, and when I got out, didn't really know what I wanted to do, but went ahead and went to college, and my insurance agent happened to be a friend of mine. And so we just got to talking, and he goes, why don't you just do insurance if you don't know what else to do? And it happened to be there was 3 other guys that were shelter agents as well. So I had 4 local guys here in my town that, did shelter insurance. And so that's kind of how I got into doing insurance, and having someone there to help along the way and show you the ropes and everything is a great tool. And so it's helped me to be very successful. And I was happened to come across a friend of mine that I went to school with in college, and they did some rental houses, and so got in with them, and they started inviting me to go to investor meetings. And so I used to share information about insurance, going to all these investor meetings. And since that was back in 2008, 2009, when the market crashed and a lot of investors were coming in, buying up all these properties. And since then, it's just been a whirlwind, and it's just been blowing and going. And now I have, close to 1,000 rental properties on my books. And so I've heard the same questions over and over again from investors over the years. So I'm pretty well versed on the answers. So
no, that's great. We appreciate you giving us that background. It sounds like you broke into the investor space, becoming kind of this or creating this niche simply by surrounding yourself with investors, going to these meetups
right.
and these groups and presenting for investors. I mean, it's a very, I guess, unique niche where it's quite different from someone that just has a primary residence and they're looking to insure that property versus someone that has multiple rentals spread across the country in different areas, and coming up with a insurance plan to make sure that they're protected, but also have appropriate policies in place where they can still cash flow. Can you start by giving us just kind of a quick summary and maybe bullet points or something as far as like what are the differences when you're looking at insuring an investment property versus, say, a primary residence or some other type of property that you have?
So with your primary, excuse me, with your primary house, you're going to have full replacement costs most of the time. I'd say probably 98% of the time, unless it's an older house, then you can get like what we call a market value type policy. But most people will have what we call an HO3 policy, which is a full replacement cost policy. And what goes into that is a cost estimator. We have to put in there how many square feet, what year it was built, brick or frame, how many bathrooms, what kind of flooring. You put all that in there, and it tells us at the end how much insurance to put on the house. So that just means if there was a total loss to the house, we would have enough money to cover that house to have it rebuilt. With investors and these rental properties, a lot of times when they come to me and they already have quotes from other companies, they are getting full replacement cost policy quotes from the other companies. And that's just because the other companies don't offer an ACV or an actual cash value policy. So their rates may be a whole lot higher than what we can offer. And so if you want to do, let me go back and say what ACV, actual cash value. So basically, if there was a claim, you would take how much it would cost to repair the damages, subtract out depreciation, and then minus your deductible, and then that's how much you would get. So the question becomes, do I get ACV policy or do I get a full replacement cost policy?
Why would someone not need or in your recommendation, why is it not necessary or appropriate to have a full replacement cost on a rental property? And why would someone want to do ACV instead?
Yeah, good question. So if you have an older house, let's say 1950s, 1960s house, whenever we do a cost estimator on that house, if you want full replacement on it, it's going to take into consideration that house has plaster and all these older materials in it. And that's going to increase the cost estimator. With the COVID and all that stuff going on, the cost of construction materials have gone up, as you know. And right now, just if you have a regular house that was built in the 1980s or sooner, these cost estimators are running $135, $140 a foot. If you take a 1940s, 1950s house and you run a cost estimator on that, it can run as high as $160, $170 a foot. Well, so if you have a 1,200 square foot house, you may have to get insurance on it for $180,000, $190,000. And so that increases the amount of insurance that you're going to pay on the house, therefore decreasing your cash flow.
When the house at $190,000 replacement cost could have been like a $100,000 house, right?
So if you paid a 1,200 square foot house, if you paid $120,000 for it, then what we normally do is just do $120,000, ACV policy, actual cash value policy on it. And so if you have a total loss, here's the point that I always make. And I'm not trying to push an investor towards this way. I just always like to give them enough information so they can make a decision on their own. But if you have a $120,000 policy or $120,000 worth of coverage on a policy, if you have a total loss, then shelter pays the limits of the policy, which is $120,000. And then they give you another 10% to scrape everything off the land. And then basically you can just sell the lot, take your money, go buy another investment property and keep your cash flow going.
I mean, that's a key point. It doesn't really make investment sense to rebuild that property at a higher dollar amount. And that's why it's probably not necessary, and why we see everyone usually going with an ACV is it allows your premium to be lower because it's insuring for the amount that you're into the property for. Right. It would probably make sense to, if you were to have a total loss, which would be rare in most instances, but to take that money and apply it to other investments. And then you're still coming out on top with still owning the land, but probably not a scenario where it makes sense to rebuild that same property in that type of neighborhood. No, Adam, what do you think?
So if I live in Texas or California or New York or what, why in the world would I want to mess with trying to build a house back and contractors and everything else from that far away when I can just, sell the lot and go move on to another investment property and keep my cash flow going? Yeah.
Yeah, absolutely.
And on top of that, if you've had that house for a while and you've built up some good equity into that house, well, you're taking that equity with you, so.
Yeah. So when it comes to these policies, like how do you compare across it? I mean, so let's say I get a quote from you and I call another company and they give me, another ACV quote and I get them back and they're different. How do you compare the two? I mean, a lot of people just say, well, this one's cheaper, so I'm going to take this one. But what actually do you need to take into account when you're looking through these quotes?
So to be honest, I mean, usually we beat all the other companies on rates with the ACV.
That's why we work with you, Bill.
Yeah. So with the,
full,
yeah. So thank you. I appreciate that. So with the with the full replacement cost policies, those, we can be competitive sometimes, but the ACV policies are really, our bread and butter. And one other thing on that aspect of going with the full replacement cost policy, if there is a total loss, you do have the option to go with the market value if you just want to settle up with the company to get the market value price. But in the meantime, you've paid all this extra premium in insurance. So,
and that cuts into the cash flows as we were talking about.
Right.
Let's go through some specific coverages that I see quite often. Usually when an investor is looking at an insurance quote, it's sometimes just foreign language. There's a lot of different coverages and deductibles and things like this to look at, and it's usually hard for someone to just say, okay, what are my options even to look at this and say what areas can I change, what is actually necessary.
Right.
The actual insured value, which we just talked about, is probably the biggest thing. It's not uncommon. We encourage people to get multiple quotes because that allows you to go through and compare and contrast, as you should. That's part of being a savvy investor, is having multiple quotes to see what is the best quote for that property. And that could vary per property in different geographic locations.
Right.
One insurance provider could be an excellent provider in one location and not work in the state that you own other properties in, or not be the best person in that state. So it's always good to have a few different people to compare and contrast. But when I'm looking at a policy, some of the things that stand out to me is this necessary, or can this be changed? Is, of course, like we talked about, the replacement cost versus ACV. It doesn't make sense if you have a $100,000 house to be insuring it for $200,000. We want to make sure we're doing ACV. In fact, in some cases, we won't get in this too deep in the woods here, but I actually mostly insure my properties for loan balances. Not all insurance providers can do that. Actually below the full purchase price of the property. That's potentially an option to look at to lower premiums across the board. Also, things like liability insurance, loss of rents. What is a typical and expected amount? Usually the lender has a requirement for minimal liability. We've seen anywhere from $200,000 to $2 million in liability, that's a lot of liability insurance. What do you see as kind of the norm and kind of the expected amount for a liability policy? And this would be for tenant slipping or someone being injured at your property, having a liability policy in place, which is important and required. What's a standard and typical amount that you would say is adequate in most cases?
So for liability, when all this started blowing and going in 2008, 2009, the investors were just jumping on board with $1 million liability. Now, $100,000 comes with the policy, but for whatever reason, the investors love that $1 million number. And so I always quote it with $1 million, but I always tell them you can get less if you want to, but they 99.9% of them want, the $1 million coverage. Now, as far as claims go, we hardly ever have any claims at all on the liability. Here's the thing to remember on liability claims: you have to be found negligent in some kind of way in order for that policy to pay out under liability. So if you have, let's say you have a porch on the front, we paid on one of these one time, $5,000, I believe it was, a long time ago, but it was an older house, and the front porch had some rotten wood on it. Someone came through there and they fell through and injured their leg. So something like that, you have to be found negligent. So you did something wrong in order to cause that person to get injured. So just remember that it's not all about, how much you put on there, but it's more about what makes you sleep better at night in case there is something that happens to go wrong that you didn't know about.
When I'm looking at $1 million liability policy, I think that allows most people to sleep pretty good at night, because that's a lot of liability per property. Remember, there's additional things that we're putting in place for liability in general, setting up an appropriate LLC structure to make sure it's limited to that specific property. But there's a whole litigious process that needs to be followed to actually even find that, like you said, the owner is negligent, so that policy actually would pay out. But have you seen any instances where there's $1 million liability in all your years? I mean, is that an astronomical number? Or is it?
I mean, I can say in the 21 years that I've been doing this, I might have had on rental properties, I might have had 2 liability claims.
And that's the thing.
$5,000 one, and the other one, it was just so minimal, it wasn't even worth mentioning. So
and all this is a cost benefit comparison that everyone needs to run a cost benefit analysis to see what is reasonable and adequate based on your risk threshold. And it's important to know kind of statistics out there of what are we actually seeing. I've never seen, now that's a fear of an out-of-state owner always, is what if the tenant or somebody gets hurt at that property? Will it be held liable? And that is a potential, and that's why we have liability insurance. I've never dealt with a liability claim with any of my tenants, nor have I seen one with any of our investors or anything. You know, I mean, even you who specializes in the insurance realm, I think you said a couple instances over 21 years. So, I mean, it's something important to have, but statistically speaking, probably rather rare. Another big thing is loss of rents. And first of all, can you explain what loss of rents is if you have a policy and you lose rents during that? I mean, is that necessary? And what does that actually mean?
So with our policies, whatever your dwelling amount coverage is, so if you have $100,000, we'll just use some round numbers. If you have $100,000 coverage on your policy, our loss of rents is an automatic 10%. So it comes with the policy. There's no extra charge for the loss of rents. So you have up to $10,000 for loss of rent. So if the tenant, if there's a loss to the house, whether it's a wind claim, a tree falls on the house, whatever, and that tenant has to, or a partial fire, whatever, and that tenant has to move out for a little bit until that house gets repaired, then we will pay you up to $10,000 for loss of rents until that tenant's able to move back in. So we're going to cover your rent, whatever your rent is for the month. You get paid that every month until that tenant gets to move back in, up to $10,000.
That's one of those things I see a lot. Sorry, Adam, I keep cutting you off here. Just on loss of rents, because this is something I'm always evaluating, going over with my own rentals. Some insurance providers it will be an additional premium. Yes. It'll be an add-on to have loss of rents. In your case, you have a certain threshold that you include with every policy. I mean, that's one of those things that is nice to have when you need it, but probably pretty rare that it's going to be needed, because a claim needs to be made on the house. This isn't where, hey, you just have an eviction and you're filing an insurance claim, right?
Yeah, these really don't happen that often. Most of the claims that we have on rental properties are wind claims, replacing the roof.
Sure.
Yeah.
So when it comes to getting that, $1 million of liability insurance that you say a lot of people like to have, what kind of price increase does that give the policy? I mean, how much does that actually cost the investor a month, roughly?
Yeah, it's state specific. So maybe like in Tennessee, it's $77 a year. In Ohio, it's $90 a year. Missouri's $90 a year. So you can go with lower limits, like $500,000, for $47 or so if you wanted to do that. So you have the option to use different amounts if you want to. It's just everybody's just comfortable with that $1 million amount.
Well, when you talk about it that way, it sounds pretty reasonable, actually, for $47 a month to have 500 million.
I can sleep very well at night for $90 a year.
Maybe not on a $90 mattress, though.
That's right. That's right.
So one of the things that as people grow their portfolios that I've been asked about and I'm kind of curious about is, whether or not it's better to get individual policies or do some kind of umbrella policy on their properties. What are your thoughts on that?
Okay, so there's two things there. One, we offer what we call a general liability policy. So if you're paying the $77 a year in Tennessee for an investment property, well, once you get up to a certain amount of properties, you can actually take that liability off of the property policy and put it under a general liability policy, so that if anyone gets injured on any of your properties, that coverage pulls from the general liability policy. It's kind of like an umbrella, but it's just for liability only, of course. So the cost for that is $51 per property. So you're saving $26 a year by moving all your liability under this general liability policy. So either you can keep your $1 million liability under each policy and pay $77 a year, or you can take that liability and transfer all of it from each property to this general liability policy and pay $51 for each property.
So there's a lot of different ways to potentially do that. We're talking about something that's really specific with what you see. You can take, and most insurance providers offer some sort of general liability policy that you can initiate. but then you can also buy additional umbrella policies
Right.
above and beyond that. Is that something you see a lot? Is that necessary?
I would say maybe 2 to 3% of investors that I have actually have an umbrella policy. So if you have an umbrella policy with another carrier, because you have investment properties all over the United States, then you can, now that carrier has to be licensed in each state in order for you to carry that umbrella policy. But if you have $1 million or $2 million umbrella policy with another carrier, and you have your investment properties with me, then each investment property that you have with me only has to carry $300,000 worth of coverage. And then if there's a claim for over 300,000, then your umbrella is going to pick up the rest of it up to $1 million or $2 million, whatever you have on that umbrella policy.
Okay. And so whenever you're looking at, so this is kind of whenever something actually happens to your property and you need to file an insurance claim, and this is kind of the catch-22 that a lot of people find themselves in, is how much does a claim impact your next year's bill? And so when is it actually worthwhile to file a claim for home insurance?
Yeah. So I would say the smaller claim, now you got to remember, whenever you file a claim, that's going to stay with you, right? So you don't really want to file a claim unless you have to. And I can never tell someone not to file a claim. It's up to them individually if they want to file a claim or not. But weather claims with us, weather claims, if it's an act of God weather claim, then it does not impact you at all. You can have 3 weather claims if you want to in 1 year, and it's not going to impact you at all. But if you have something like a fire, theft, water, frozen pipe burst, those kind of things are 15% for the next 3 years, and then they fall off after 3 years.
Okay.
What's and that's
15%
a very good
increase of your total premium that you pay a year.
Right.
That's a very good point, Adam. I'm glad you brought that up, because that really comes down to, yes, when should you file a claim specifically, and how that's going to impact you with other properties. I mean, because it could, if you have multiple properties, affect, I mean, if you file a claim on that's not an act of God or one of these environmental issues, I mean, is that going to affect other policies as well?
No, just that specific property.
Just that specific property.
Yeah.
Okay.
And if you end up selling that property and going, then you don't have anything really to go. Now, if you leave, if you're with us and you have that claim and you decide to move those, and it's with any company, if you're with another company, you come here, we're going to run that, what we call a clue report, to see if you have any prior claims. And if you have a fire or theft or something like that, I mean, with shelter, we can't even write it if you had one of those in the last 5 years. But if you've had weather claims, then we can write those. Now, if you've had a small water claim or something like that, a lot of times we can negotiate with our underwriters and sometimes get an exception.
Very good. Let's talk about the cost of insurance and typical deductibles. As you well know, most of our properties are going to be the recent rehabs in that $100,000 to $300,000 range on average. We have some new construction stuff, of course, but for your typical turnkey rehabbed property, I mean, what would you say your typical premium that you're seeing for most properties? And I know this varies state by state, and there's a lot of things to look at, of course. But if we had to look at a range of what is a typical insurance policy cost that you're seeing for these type of rental properties, and what is an appropriate deductible for people to look at, because we see deductibles from $1,000 to $10,000. Obviously that's personal preference and something you need to balance with how that's affecting the premium. But what's your opinion on that?
In Tennessee, we have very inexpensive rates. I would say like on $100,000, and I just like using $100,000, but like on $100,000, you can get it for like $450 a year with $1,000 deductible. Whereas if you have one in Missouri or Ohio, it may be, $650. So it's between, $150, $200 difference, just varies on state, but that's with a, $100,000. So, so once you start moving on up to 150 and 200, then you're going to be, dealing with some higher insurance premiums. But when investors first start out, they're really comfortable with that $1,000 deductible just because of the unknown, and they don't know, if they're going to have any claims or not. But once they start moving on up and start getting 4 or 5 rental properties or more, then they're more comfortable to go with the $2,500 deductible, because now they're saving that extra money on their cash flow. And if they have a claim on any of the properties, then they have the $2,500, backed up in cash flow to use.
Yeah, that makes sense. I think that's appropriate. I mean, we typically tell people between $400 to $800 for a typical rental property
Mhm.
for insurance, and I think that's right in line with what you were saying. Obviously,
Yep.
we kind of run our pro formas geographically based to look at what is an estimate, but that's I think it's important for everyone to know too. Even though we may have, or anyone that's showing a property pro forma may have an insurance allocation in there, that's subject to your change, the investors specifications that they want in those premiums, and there's always things that can fluctuate within that, right?
Yeah, I mean, they can choose to. You were saying before about how much do they need to insure the house for? I always go with how much money have you spent out of your pocket? So I mean, if you've spent 120,000, you bought a house plus rehab is $120,000. Well, then you need to put $120,000 on there because if you have a total loss, you get all $120,000 back. Most of the banks that I see, they only want to cover the loan amount. And going to another point on the replacement cost, a lot of people come to me and say, my bank is asking for replacement costs. And the bank loan officer will send me an email saying, I need to see a cost estimator. We need full replacement costs. And I say, no, the investor has the choice on which kind of policy they want. So, and I just have to let the bank know, I'm 100% on this so far, but I just have to let the bank know that if there's a total loss, then the full amount of the policy limits are going to be paid out, and then they're fine with it.
Generally
so a lot
speaking,
of people get stuck on that.
Right. And that's a good point. Generally speaking, when we're working with a newer investor and they get this quote back, we've shown, say, a $600 insurance premium estimated for this $130,000 house, and they get a quote back for $900, and they're going, well, you said it was $600. Well, I mean, that's obviously an estimate, but it's really important that the investor knows, okay, let's look, you got to look at the policy. This is part of the educational process is understanding these quotes and determining what is the most appropriate insurance for you. Comparing and contrasting multiple quotes. We want at least 3 different quotes from different providers. We want to look at, the different things that are in there that we could possibly change. Because yes, if they're giving you a replacement cost, if they have $2 million of liability, if they have a $20,000 loss of rent in there, I mean, those are all things that can be adjusted. And maybe that's at a $500 or $1,000 premium or deductible. Those are all things that can be changed to still have adequate insurance, in my opinion, and lower that premium dramatically to still have adequate cash flow. I mean, what's your, Adam, what are you typically seeing on some of your rentals, and what things do you like to add in or remove or limit?
Yeah, I think I spend about anywhere in that 450 to 800 or 900 for it. And I found, and this is one thing I wanted to touch on with you, Bill, is I found a lot of people were surprised. I know it's been happening in Florida. We've gotten it with the hurricane and with that. But I was surprised myself whenever I bought some of my new construction, in that new construction was cheaper to insure for the most part than the rehab properties, even though the price point is higher. I tend to go with like a $2,500 or $5,000 deductible. I kind of do it where I look at my break even point. I say, okay, if I do $2,500 here, I'm going to save this much. And so in this many years, it's going to cost me this much. How often am I going to be making a claim type thing? But that's kind of where I tend to stick in that $2,500 to $5,000 range. But why is new construction cheaper to insure on a general basis?
Well, 2 things there. One, when we do the cost estimator, we're using today's materials. So you're not going to get that $170, $180 a foot like we were talking about earlier. So you're going to get, the $135 a foot range, $140, just depending on whether or not it has a garage or not. And then 2, also with us, we have a policy called an apartment owner's policy. And so if you have a house that's 20 years or newer, we can put you on this apartment owner's policy, and it gives you that discount for having the newer house. I mean, I did some the other day in Arkansas for, I think they were $140,000. No, I'm sorry, $180,000 coverage, and it was only $460, $450 a year because it was new construction. They were all built between 2019 and 2021. So some things are out there. You just have to talk with your agent. And there's been some times when, a lot of times actually, you guys send me investors and I talk to them and I spend the time just like I'm spending with you to explain all these different aspects of policies and what to do. And a lot of times they'll say, I'm going with you because you've given me more information than all these other guys. I mean, all these other guys just spit me out a quote and said, see you later. And you've actually taken time out to, explain to me, I feel more comfortable about what I'm buying and what I'm getting. And because you spent that extra time, I'm just going to go with you.
To educate them on what's necessary for a rental property, right?
I try to put myself in their position and say, hey, what would I want to know? And so you were going back and saying, you were asking, what do you put on a policy? What's really important to put on the policy or not put on the policy? I mean, with our policies, you're going to pay for the coverage amount, the loss of rents are included. You're going to pay for the liability. And other than that, if you want a drainage system endorsement, you can put a drainage system endorsement on there. But basically, that's just the backup of toilets or backups of, bathtubs. That we never have those kind of claims. I'm not telling you not to get that claim, but if you see that on your policy, you may want to save some money. It's like $45 a year. But never have those claims.
I mean, that's so important, Bill, your point about spending time with clients. I mean, that's why we are recommending you, not only because you offer very affordable policies and you're a professional and specialist in the investment space, but we always want to make the point to all our clients that you're building your team, right? When you're building a business of multiple rental properties across the country, it's important to have professionals as part of your team that work in the space that you're operating in. There's a lot of different insurance options out there, but it's important that you have someone like yourself that's knowledgeable about rental properties and has been in this specific industry for many, many years. Same thing with real estate specific attorneys, CPAs, lenders, property managers. I mean, the list goes on and on. You want people that are familiar with investment real estate that you are actually focusing on. And it's going to take the time to actually sit down and educate you and walk you through the different options. Most people don't know how, and I still don't know how to, when I'm looking through an insurance policy, it's like, what the hell is this? And, what are my options even with this?
Well, I can make them feel comfortable about, if you're going to see something, what am I going to see? If I'm going to see anything, what am I going to see as far as claims are concerned? I'll say, all right, here's what we normally see. If most of the time, 95% of the time it's wind claims. Every now and then we'll have a fire due to electrical or something like that. But a lot of times these houses that are rehabbed, they've upgraded the plumbing, they've upgraded the electrical, all that kind of stuff. So we really don't have those that often. I mean, it's mostly wind. So
and that's something that's usually covered as standard, right? Wind and hail and things like this. I mean, that's in every policy that you're seeing.
So there are 4 different ACV policies. If you want to get into that real quick, the basic policy is just your, wind, lightning, hail, fire, all that kind of stuff. Then you can add on the second one that you can add. There's an endorsements that you add on to this basic policy. And so the second one, you can just add on vandalism and theft if you want to. And a lot of people are just fine with that, just having that coverage, and that's it. The third one that you can add on that costs you about $80 or $90 more a year is freezing of pipes, accidental discharge of water, falling objects. If you have a big tree that's hanging over the house, if there's a chance that tree limb might fall and come through the house and cause damage, which if that does happen and water gets inside and, the tenant has to move out, that's when the loss of rents kicks in. But that doesn't hardly ever happen at all.
Let's talk about those endorsements. Did you cover all those 4 that you mentioned?
Yeah. So that was the 3. So basically people investors normally either get, just depending on the location, right? So if you're up in Ohio or Illinois, Indiana, somewhere where it gets a little colder, you may want, to have the freezing of pipes and accidental discharge of waters. Now here's the kicker. You can always add this on and take it right back off, but nobody wants to babysit their insurance policy. So they either get it or they don't get it. So they usually make that decision. Whenever I send my questionnaire to the investors on the front end, I say, do you want this or do you not want it? And which deductible would you like to have?
Yeah, that brings up a very good point with insurance and how it generally works. You can change insurance at any point in time. You can cancel policies at any point in time. It's all prorated based on how long you've had that insurance policy in place. And this really goes across the board with different types of insurance. You're not locking insurance. You're not like committed to this for an entire year. You can add on things later and change things. And it's all going to be prorated based on how long you've had that portion endorsement that you're now removing, or, what is the term of the policy that you're adding it on, right? It's all based on proration.
That's right. Yeah.
So let's go through some of these endorsements, because there's a few things I think are important to probably think about. The only claims I've ever made on my properties in the past that I think actually probably is an important one is the theft and vandalism. Because if you have a tenant, that this is kind of the reverse liability aspect of it, where if you have a tenant that actually damages your property and you got to evict them and things like this, and you get a police report showing they vandalized the property, even though you have their security deposit, that only goes so far. And so most of these tenants, it's unrealistic to actually pursue them legally to have any recapture of funds, plus there's legal costs involved. It probably makes more sense to have that theft and vandalism policy in place where you can have some coverage if the tenant actually damages the property. That's something I have seen and have personal experience with, and something I always want to keep on my policies. Any comments on that, Bill?
Yes. So back from 2010, and this is in the Memphis area, but back 2010 to 2015 area time frame, we were having a lot of issues with tenants tearing up the houses, people coming in, tearing into the sheetrock and stealing copper tubing, all that stuff. And then they were taking it down to a site and selling it. Well, the police department finally got wind of that, and they finally went down there and stopped all that. So I would probably say since 2015, it's been relatively quiet on that front, because tenants were tearing up so much of the houses back then. Shelter actually moved, and we no longer actually cover that if the tenant tears up your house. So that being said, it's never a problem. Never have that issue. I may have one claim a year with that happening. So it's not likely that's going to happen, but it can, of course. I mean, that's what insurance is. I mean, anything can happen. But I would say, for our policies, and I'm not sure about other companies, but our company made a move to not cover that anymore.
So is that an endorsement that can be added or no?
No.
It can't be.
No.
Okay.
But it doesn't since 2015, it's been a rare occurrence that even happens.
Let's talk about some other endorsements. We talked about sewer line and freezing pipes. We have seen a couple of instances, and everything we're talking about, even going back to the theft and vandalism, to your point, like less than 0.01%, is extremely rare, but these things potentially can happen, right? Mm-hmm. So either you have reserves, and have multiple, that's why we have multiple properties, in the instance to cover, make sure you're still positive cash flow in the instance that one property has a tenant issue or whatever the case is, that allows you to have a more well-balanced portfolio. But some of these other endorsements, I mean, we've seen a couple instances where sewer lines did back up in front yards, things like this. And thankfully those investors had those endorsements in place. That's something to think about. The freezing pipes.
I have a comment on that one, just so investors here. I declined that $15 a year option in my Jackson, Mississippi home shortly before the great freeze that happened there that burst the pipe, and it cost me about $5,000 to fix.
Well, the question, Adam, becomes, what was your deductible on that? Was it? It
would have been about $2,500.
Okay. So, and then there's cost benefit, so you potentially could have filed a claim for the extra $2,500 if, and that was a natural disaster. So
if, just so people understand, if the plumbing in the yard messes up because a tree root or something like that grows into it, that's not covered. You would have to get someone to come out there and dig into your yard and get that covered. Yeah. What we're talking about is if that came back up into the house through the toilet or the sink or the bathtub, and it got splattered all over the sheetrock or messed your floors up, then that would be covered on the inside. But just because
internal piping,
I've had plenty of people that have called me, even with just primary homeowners policies, if something happens, that we're insuring the house, we're not insuring what happens out in your yard. So that tube, that pipe that goes underneath your yard down to the sewer line, the main sewer line, that's not part of the structure. So
thank you for painting that vivid picture of sewage backing up, splattering onto the wall for us.
It happens, but it doesn't happen.
It happens.
But once again, you're talking that a backup of sewer claim. I don't even know. I think I've had one in 21 years, and it was a primary house.
And we're getting really into the weeds of specific, scenarios and details, so I think it's generally, but it is good to know what does each endorsement actually cover and not. I mean, that's why it's important to spend 30 minutes with Bill or anyone on the phone to go through and actually learn what these coverages actually cover, just so you're aware. So,
well, I mean, like you said, like you mentioned on the tenant, tearing up your house or something. Okay, do I have that coverage? No, not with shelter. Do I have that coverage? No. Is there a likelihood that that's probably going to happen? Not really. Not in my experience. Not in my 21 years. That's just not something that happens. So,
let's talk about kind of shifting gears here. Some things that people can do to achieve a better insurance premium. I mean, things like security systems. You can get like ADT or Simply Safe or something along these lines, relatively inexpensively allocated to the house. Is that something that lowers the premium on a rental property or not so much? What other things can people do proactively to obtain better insurance for their house?
Well, normally, when you get I don't know any investor that has a security system on a rental property. I mean, normally if a tenant moves in there and a tenant wants it, then a tenant will get it, and that'll help their insurance policy. But an investor, I don't see them, paying the money to do it because they're
not cheap, right? But definitely on primary residence, that's something we see a little bit more often.
Yeah. The thing that helps with rates, and most of the time investors are getting the best rates possible because insurance companies use what we call a clue report. And that basically your rates are derived from your credit report, credit score, claims loss history, driving record. So with each company, you're going to have a whole set of tiers, and I don't even want to go down that road. But basically, your rates are based on that consumer report, and that's with just about every insurance company. They've been doing that probably since, oh my goodness, back in the 2006 era. That's when everything about switched over.
What about making claims under a specific LLC? We talked about a claim being attached to that particular property. Most investors are trying to build a portfolio of multiple properties. So if we had a claim back in the day on one select property and that was under an LLC, or maybe it doesn't matter if it's under a person's name or LLC, is that going to affect other rates for other future quotes on other rentals they own?
To be honest, I don't know, because when we run the clue report, it's based on the individual. And once again, I would say out of all the quotes that I've ever ran, maybe less than 2% of the people actually had claims, maybe less than 1%. I mean, so it's very rare. So I don't know if they had, I don't get into the aspect of asking them, well, were you in an LLC? Should we check that? Because it's running off the individual. So if the individual was part of an LLC, I would think that it would pull, and it would, it would charge them an extra rate, or that claim would pull up under their individual, name and address.
I know some of the claims that I have, and again, out of the many, many rentals we've owned and have different entities for them, we've only had a couple of claims in our lifetime of investing. Mm-hmm. But they actually didn't show up when we have a separate entity for that next property. So that might be something to think about. Really, we talk about the liability aspect from an LLC for protecting you and separating out your personal residence and other assets, but that might have some insurance tie into it as well.
And in my questionnaire that I give to the investors on the front end, I ask them, have you had any claims in the past 5 years? And I mean, 99% of the time it's no. And then sometimes if they have had a claim, then we can talk about it and let's see how much actually was paid out. Was it on a house that you don't even own anymore? So maybe you don't even own this house anymore. Well, now I can go to my underwriter and say, hey, look, they had a theft claim, but they don't even own that house anymore. So
got it.
Yep. I want to say one more thing on replacement cost. Let's just take, for example, like in Missouri, like in Kansas City, if you have like a 800 or 900 square foot house, that was built in like 1950, but it's been, rehabbed and brought up to par, then a lot of times you can get a full replacement cost back because the square footage is so low. You can get a full replacement cost policy on those, and it'd be just about the same amount as an ACV policy. So I would say on the smaller houses, you know, check into that and see if you can get a full replacement cost policy. If it's going to be for the same money, you're going to get more coverage, right?
So case by case basis, really, and just asking the right questions.
Well, that's what, I mean, that's what I do for my investors. I let them know, hey, look, let's take a look at, you know, I'll actually do it on my own. If I see right off the bat, if I see it's a smaller house, right off the bat, I'll check it to see if they can get a better rate. Now, the kicker is this, with shelter, you know, you've got to have the plumbing updated, the electricity updated, and a new, you know, a newer roof on there. And then
because those questions are asked. I mean, sometimes insurance, and that's another good thing to clarify. Usually insurance providers are going to want typical information for the house. And so it's important to come prepared when you're applying for your quote with certain things. And I think, you know, correct me if I'm wrong, Bill, but often I see, like, is the plumbing, you know, pre or post like 1980, 1985 or whatever it is, electrical, is the roof within 10 years. I mean, you can pretty much, and it's okay to not know 100% right now. You may not know. Sometimes we just don't know about a previous roof. If you can't, you know, actually look it up and see. So it's okay to give estimates to the insurance provider to get a general quote, and you're not going to hold that against them as long as they're using their best available knowledge at that point in time. And you can amend that later once they have the exact information, correct?
Yeah, I mean, a lot of times, I mean, they're going to get an inspection report anyway, but a lot of times they can go back and ask, you know, down the line, they can ask enough people to find out whether or not, you know, when that actual, you know, plumbing or electricity was updated. They normally come back to me and give me the answers. I don't really have anybody that comes back and says, I can't find out that information.
But it's okay to quote, you know, initially, right? With the understanding that you can go back and amend that. You're not signing in stone immediately today that, oh, if I said it was 1980, it was 1982, you know, you can go back and amend that later once we get through the inspection reports. Because often we encourage people to start looking at quotes for insurance during due diligence, often before the inspection or appraisal is back. And so we'll provide that information if we have it. But even on some of their own rental properties, it's okay to give general statements and go back and amend them later as you get that information.
Yeah, it normally doesn't come up unless it's like a 1940 or 1950s house, something like that. Sure. Yeah.
All right.
And one other important thing to remember as an investor, if you have a policy, if you have a renter in there or you sign on with a policy, I mean, most of the time these investors, you know, they buy a house and then bam, there's a renter in there within the first couple of weeks. If you sign on and have this freezing of pipes, accidental discharge of water, theft, vandalism, all that, after 30 days, if there is no renter in your house, then you lose those coverages. It just goes to a basic policy, which is the fire, wind, lightning, hail, that kind of stuff. So that's very important for an investor to know.
So you would have to go back and add it on later?
So sometimes if I have investors that have 5, 6, 7 houses, they will call me and say, hey, this house is going to be vacant. You know, we got to do a little bit of rehab on it, whatever, and then we'll put a renter back in there. And then that vacancy rate is a higher rate. I mean, normally we don't insure vacant houses, but if you're an investor with us, then it's just going to be for a little bit. We'll charge you the extra rate for the little bit, only for the prorated time that it's down, right? So it may only cost you $30. I just did that one for one of my investors, and it cost them $30. So anyway, but it's important for you to know. So even though you're paying, you know, for a better policy, if you file a claim and the claims adjuster goes out there and, you know, they're going to ask for, you know, a lease, you know, written lease for 12 months or whatever. Well, if you don't have one and you just haven't had a renter in there for 30 days, even though you're paying for that extra coverage, you don't have that coverage.
So it's important to communicate with your insurance advisor. Yes. And I think if we kind of summarize this entire conversation just in a few bullet points, kind of what my takeaway is, first of all, make sure you're working with an insurance provider that is familiar with rental properties in the area that you own rental properties in. You can go to one of these big insurance providers and get quotes, but insurance is sales, right? And so we understand that sometimes, and this is not the case with Bill, we know that you understand rentals, you offer very affordable and adequate coverage out of the gates, but sometimes some of these big name insurance companies will want to sell you as much insurance as they can because some people just never question it and just sign up for it. But it's important to understand insurance and go through and look at each policy on a case-by-case basis to see, is this adequate? What's potentially unnecessary? What are areas I can remove or add on to provide that coverage and have the premium and deductible amount that I'm looking for to meet my cash flow numbers? And you just got to look at it. So don't take every insurance policy as just at face value. Investigate it. Look at how it conforms to your goals and risk threshold and cash flow analysis. Talk with the insurance providers. And then, once you have the insurance that you want, you make it effective for the date of closing. Lenders need, that's one thing that's a lender requirement before you actually close on your transaction, is the lender needs to see that insurance is in place. But that doesn't mean you need insurance 2 weeks prior to closing. You just need the effective date, the date of whatever you're scheduled for closing, right?
Yeah. So, excuse me, my voice is starting to give out now. But normally the investor will call me and say, "Hey, I'm going with you," and I'll say, "Give my information to your loan officer with this quote," and they'll send me what they need. And the loan officer will send me an email saying, "Hey, I need a binder and an invoice," and I'll send that over. And then once it's closed, they'll just cut the check to shelter.
All right. Sounds good. Well, Bill, is there anything else you want to tell our listeners before we wrap it up today?
So let's just go back to what we said in the very beginning. If there's any kind of coverage that you're really concerned about, and the insurance company doesn't offer it, well, then keep searching around until you find one that does, right? Because what does it all come down to? Whatever helps you sleep better at night. If you're going to toss and turn in the bed at night, wonder and stare at the ceiling and wonder, oh my goodness, what if that claim actually happens and I don't have coverage for it? Then you're on the wrong policy. All right. So I just want to make it, whether that's your car, your house, your umbrella, whatever kind of policy it is. I'm not talking about just rental property specifically. I'm talking about any policy you have. You have to sleep very well at night, knowing that if something happens, you're covered.
And being educated, all right, about what the insurance actually covers. Sometimes, people are a little bit more risk adverse or whatever the case is. Sometimes they lose a little bit of sleep because they just don't fully understand the policy. And the reality is they do have adequate coverage. So education is key. That's what we're all about. Bill, thank you so much for your time. This has been very educational.
Absolutely. And to everybody else out there, if you want to get in touch with Bill, you can go to renttoretirement.com, click on the About Us. There is a link to schedule a call with him right there on the Meet the Team page. That's renttoretirement.com. While you're there, you can also schedule a call with one of our investment strategists to help out with your portfolio, or just take a look at the properties that are currently available there. If you have any questions for us or anything you want us to direct Bill's way, you can also email us podcasts@renttoretirement.com. That's podcasts@renttoretirement.com. Don't forget to leave us a review on your favorite podcast platform, letting us know what you think of the show and telling other people that it's a fantastic show worth listening to. We really appreciate the time that you're spending making yourself a better investor. And we'll see you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.